Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have David Weiss here as part of our very special 4-year anniversary that's been going on the entire month of June. We have 16 very special events all month long. I think that this is actually number 8, so we're halfway there. We still have 8 more to go, and we're giving away a lot of fantastic prizes in all those webinars as well. Today, David, which is a 40-year trading veteran, is here to talk about Wyckoff methodology, which is probably what he's most famous for, just general ideas of support and resistance, and also reading and understanding waves in real time as they unfold. As part of the prizes that we're giving away today includes 10 autographed copies of David's brand new book titled Trades About to Happen. And at the end of the webinar, there's going to be some quiz questions. The content is covered in today's session, so pay close attention to what David has to say. And then as those quiz questions come up, give us your answer, and I will award those 10 books to the people with the right answers. I will be asking for your BMT username. That's how I'm going to contact you after the webinar is over to get those prizes into your hands. So if you don't have one, just go to bigmiketrading.com, click on register. It takes about 30 seconds and it's free, and that way I can get in touch with you if you're one of the winners. I do want to remind everybody that the webinar is recorded. I'll post the recording on YouTube sometime tomorrow. If you're watching it there, do me a favor and give us a thumbs up. I'll also post it on BMT as always. Okay, guys, give me 1 second, and I'm going to turn things over to David. Okay, David, you should have the option to share the screen again.
All right, you see my screen?
Yes, we're seeing the publisher screen.
Yeah.
Okay, it's all good.
That's what I'm using.
Okay.
Okay, well, it's a pleasure to be here for the first time at Big Mike Trading. I've heard a lot about it. Many of my friends have spoken here and on the subject of Wyckoff. As Mike indicated, I am a Wyckoff type trader. I've been doing this going on 42 years. Much of what I know about the Wyckoff method and how I've adapted it is contained in my book, which he mentioned, Trades About to Happen. I just have here for reference. I'm not going to go through all these items, but some of the things that I look at on charts, reading the price bars and the volume, pay a great deal of attention, which we'll discuss some here, about the behavior around support and resistance lines, and then, of course, interpreting wave charts. Just a few words about my background. In 1971, I was working on a PhD dissertation in English literature, and that summer a friend of mine suggested that I come work in the technical research department of a commodity brokerage firm in Memphis, Tennessee, which is my home. Not that I live there now, I live in Boston area. But anyway, I worked in the chart room making charts for the analysts, making them by hand, and found it interesting, and the pay was better, and I just decided to move away from English literature and teaching and move into the markets. And it wasn't very long thereafter, just a few months, I was made a technical analyst, which was sort of a joke. And I was also a broker, which was beneficial because I met an individual who told me about the Wyckoff course. And in those days, when people spoke of the Wyckoff course, they talked about it in hushed tones, as if they didn't want too many people to hear about it. It was one of the best kept secrets. They didn't publicize it very much. I think they ran an ad in Barron's on Sunday, on the weekend, and that's about all. And it was mostly word of mouth. And I was, at the same time I was working in the chart room and first starting, I was reading a few books that had a big influence on me. First, it was Edwards and McGee. I wasn't that interested in geometrical shapes and patterns, but I was interested in the support and resistance lines, trend lines, channels, etc. I read Elliott's Financial World articles and Hamilton Bolton's critical appraisal of the Elliott Wave principle. And I read Humphrey Neal's Art of Contrary Thinking. I think we were all contrarians in those days. And lastly, I read a book by a man called Darvis, who wrote a book, I think it was entitled How I Made $2 Million Trading Stocks. All of these had an impact on me, and particularly at the beginning. Let's just take a look at a chart. This is a 3-hour bar chart, tightened up pretty well, of the June Canadian dollar this year. And I've drawn these boxes because this fellow Darvis wrote about how he saw the market in boxes, in trading ranges after trading ranges, in the course of a trend. And that interested me, and I saw that there was some, it made a lot of sense. And of course it tied in nicely with support and resistance. And of course from reading the Wyckoff course, I found out about false moves on either side of a trading range of one of these boxes. A move above the top of the box that failed to follow through is an upthrust. A move below the bottom of the box for the trading range that fails to follow through is a spring. And I always tell people when I give a talk that you can make a living trading springs and upthrusts. If you want one simple strategy, it's being able to recognize and understand springs and upthrusts. But there are other springs. You can look on this chart and you can see just at a glance that there is a spring right here where the market goes underneath a low. And you can also see that there is a tiny upthrust at the high, and there is another upthrust right here. Well, I find this kind of upthrust to be most interesting, and also some other kind of springs than just at the bottom of a trading range. And I'll show you what I mean in just a second. But without drawing lines on this chart, it's like looking at a road map without any highway markers. And the lines tell the story. You get to see where prices accelerated down or up and how the market comes back to test those areas. Look at this chart right here. Now I've drawn all the lines. Suddenly, the chart comes to life. And I've circled the areas where there are trading opportunities. SOT stands for shortening of the thrust. And I've also called it, it's shortening of the thrust in the context of the up move. It's an upthrust in the context of the trading range. Here's a rally back up to the underside of this trading range where we accelerated downward. Markets like to test those breakdown areas. And you can make a living watching the behavior on those tests. And on this test, particularly and most interesting, there's one test of the breakdown. The market pulls back and it goes up again and has a minor upthrust. And look at the size of the break. This is the most accelerated portion of this decline. And you can also see down here the spring and the shortening of the thrust again, measuring from low to low to low to low, the downward progress is diminishing. That's what's meant by shortening of the thrust. That applies to down moves as well as up moves. And it's a very important piece of behavior that Wyckoff himself wrote about. Well, when I took the Wyckoff course, and before I go into that, let me show you what I mean. Here is a breakdown, a test of a breakdown a pullback, and then a rally again to test the breakout, the breakdown, and it upthrusts this high, and the market goes back down. That's exactly what took place over here in that situation. And then the spring on the test of a breakout, here's the breakout, here's a pullback to test the breakout. The market rallies, pulls back, and has a spring of the first test, and then pushes off, and we go into execution, into markup. These are a little different kind of spring and upthrust, but they're very much worth paying attention to. All right, let me show you next. Here is an example of one of those springs on a 5-minute S&P chart. You see the lift-off above these highs. The market pulls back here to test the breakout. You can see you had all of this increased volume on the breakout. So we test it, we come back again and test it and go into a minor spring position. We test the spring and then up she went. So this is a strategy that's a little bit different than looking for a spring at the bottom of a trading range. It's looking for a spring on a test of a breakout. And you'll find this quite often on charts. All right. Now, when I took the Wyckoff course, I was most interested in the fact that he talked about waves. I was studying Elliott waves, and one of the first things he said in the Wyckoff course was that one should think in terms of waves. And I don't know, that comes from his work as a tape reader. He watched the flow of orders into the market and saw the buying and selling waves. And what he did is later he devised a wave that tracked 5 leading markets. And he kept up with an aggregate total of the position of those 5 leading stocks throughout the day. And he sent out this report. I used to receive it also. It didn't look quite like this, but it had a chart, and it broke down all of the buying and selling waves. And it showed the duration, the price at where each one ended, the amount of movement, and the volume. Activity, oddly enough, was a measurement of how the distance the tape traveled during that wave. I guess it was in feet. Today it would be in, I guess, miles. I don't know. In any event, you can look at this chart and you can see this number 6 wave. If you look at it closely, I drew an arrow here. It's getting very tight. And look at the wave volume on that down wave. It's only 68,000 shares, the smallest amount of wave volume for the day. So that tells you something is about to happen here. And then we get this burst of demand on 238,000, and we get the biggest up wave of the day up to that moment, well, since the opening, 5 1/8 points. Now, Wyckoff didn't say this in his tape reading course, but I think that Wyckoff understood that price movement does not unfold in bundles of equal time. That price movement unfolds in buying and selling waves. Whereas you can subdivide a day into 5-minute bars and not have any difficulty determining the trend of the prices. When you subdivide volume and dissect volume into equal bundles of time, you lose the true force of the buying and the selling. That's the premise that I've worked with in developing wave charts. And I'll show you how I did this. I couldn't survey every tick like Wyckoff did. So this is a data sheet that I kept. This is a late one, September 2002, on the December 2002 contract. And what I did is I wrote down the price for each 1 minute period and the volume. In 2002, the volume in bonds was tick volume. We didn't have actual contract volume at that time. And this was a low point, and the wave size is 330 seconds. So it had to rally from 112 even to 112.03 to know that that wave had ended. At this point, 10 minutes later, it has a 1 minute close of 112.03. And so I added up all of this volume and that volume and began totaling it as the market progressed. And you can see we went all the way up to 112.25 on 159 ticks. The next up wave went to 112.28, and it was only on 32 ticks. The next up wave went only 3 ticks higher to 112.31 on 88 ticks. So we're not making much progress, and then here's a change in behavior. Right here, the market drops 830 seconds on 46 ticks, which is the heaviest downwave volume so far during that session. And there's one more up wave to 112.27 on only 8 ticks. So you can tell right here that demand is spent, and the market drops to 112.19 over the next 13 minutes on 46 ticks. So you can trade from this kind of information is what I figured out. Any questions about what I'm doing?
There's not any questions yet, so I think we can keep going for now.
Okay, good. All right. So the next step was to make the chart. This is a later sample. I plotted this, I did this by hand in those days, and the waves are equidistant from one another. You can't tell how much time is on each wave. But I'm looking for changes in behavior, which I'll describe more of and illustrate in a few minutes. But you can see on this up wave, right here at this top up wave, there's a great deal of volume. And after that, the market turns down with the heaviest amount of selling since this low over here. And so it became clear that the force of the selling had overcome the force of the buying, and the market was in a position to turn down. Well, I made charts like this for many years, starting in the early 80s, all the way into the first part of the 21st century. And I wrote reports. This is a report of the S&P 500, the large contract, in July 1999. And these waves were constructed not from 1 minute data, but from 15-minute data. And the wave size, the minimum wave size, I believe, was 5 points, not a small amount. So this was a wave chart that I used for a bigger picture to demonstrate in my reports what was taking place. And you know, here's a note right here. This first up wave has volume of 5,955 contracts. It lasted 47 15-minute time periods, and the movement was about 40 points. So great ease of movement, great demand, so forth. This next up wave here, where we break out above the April-May highs, was about the same size, but the volume is much bigger, and it took more time. And then on the last up wave here to the July 1999 high, which many of you may remember was an important extremity, not the extremity, but an important one. The volume here is quite a bit bigger than on wave 1. The time is a lot more, but the distance is not very much, telling you that the market is in a vulnerable position. because there's been a lot of effort and not that much reward in terms of points. I'll show more about that in just a second. So these are some diagrams of how I go about reading waves, and I remove the price bars. They're hidden. And this is an S&P chart. No, I'm not sure it is. Whatever it is, you can see these are in, I think, thousands of contracts. And the market makes a new high, and it's 74,000. For all that effort, we didn't make much progress, and the market turns down. It's also a potential upthrust. And then on the pullback, we have the smallest amount of upwave volume on the chart. There's no demand. This is the place to initiate, when it turns down from here, initiate a short position and put a stop above the high. Another trading strategy that I use, here's a market in a progression of up waves. We have very heavy volume here. We had good demand in here. But on this down wave, we have more selling pressure, more volume than on any previous down wave. I consider that a potential bearish change in behavior, and I want to watch and see what kind of behavior occurs on the up wave. And if the volume is low, and of course if we fail to make a new high, as soon as it starts to turn down from here, I can go short with either a stop here or above there. All right. And then this is another example. This one's tied to a spring, but you can see that in terms of the volume, we've got 4,400 contracts on this last down wave, which is the heaviest since this large down move, and there's very little progress made, great effort and little reward. So when it starts to turn up, go long and put a stop underneath here. Notice also the angle of that decline. You notice that it's not as acute as these down waves were. That shows what the difficulty the market was having making downward progress. All right. And then, of course, we had great demand on this rally, stopping up against this, trying to go higher, but this market went much higher after this. All right, here's another example. This is a stock, I think it's Google. The volumes are in thousands of shares, and this is all one day, June the 6th of this year, and the market was coming down. We had 85 and 89,000, at 113,000. There was no demand in here at all. Then down on 321 and 237. But here it is, an unobtrusive 140,000 on the upside. That's a bullish change in behavior. That's the heaviest amount of upwave volume since the opening over here. Then it pulls back on only 49, which is less than on the last three down waves. When it starts to go up again and takes out this high, you could make the bet and go long and put a stop underneath these lows for a pretty low risk trade and plenty of movement, and it continued higher the next day. Okay. This is a chart of the 10-year note. The wave size is 1/32. It's constructed from 5-minute closing data, but the price bars are hidden. You see the shortening of the thrust here, and then right here is the bullish change in behavior. 82,000 contracts as we break the downward stride, and from here we have the lower volume pullback. This is the lowest amount of down volume since way over here during the early morning. And the next down wave has absolutely no selling pressure at all. So one could have gone long as it turned up from here, with a stop, or after this pullback with a stop here also. So here is a spring with a bullish change in behavior and a light volume secondary test with no supply. Okay, here is the essence of watching a wave chart. Notice here, you go up on 72,000, the 7,200. You pull back, you go up on 5,800. You have a shallow correction, and the last up wave is on 1,100. Wyckoff wrote in his tape reading course, how do you determine, and this was in 1932, how do you determine when a turn is about to occur? And he said that when the buying waves begin to shorten in length and duration, and of course duration and volume are pretty much the same thing, and volume, and the selling waves begin to increase in length and volume, that you know the market is poised to go lower. And this is a classic example of what he wrote about in 1932 in his tape reading course. And then we go up on 5,500, we fail to make a new high, and the next up wave is only on 800. And it sort of personifies something that Wyckoff wrote in his tape reading course, in his first book, which was Studies in Tape Reading under the pseudonym of Rollo Tape. And it's one of my favorite passages. I'll read it. He said, I like to read it. Successful tape reading is a study of force. It requires ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. There are critical points which occur in each swing, just as in the life of a business or of an individual. At these junctures, it seems as though a feather's weight on either side would determine the immediate trend. Anyone who can spot these points has much to win and little to lose. And this is the feather's weight. All it takes is a feather's weight to tip it over. And of course, reading the price bars, not just reading the wave, you can see the reversal action here, the poor close, the attempts to hold here and then this downward reversal. There's really little doubt of what's going to happen. All right. Well, I'm just running through all this.
Hey, David, there's a couple questions on the screen.
Chart.
If you want to take them real quick so I can try to remember what these guys were talking about on the screen. So just real quick, let me run through these. Jill is asking on your tape reading exercise, is that something that you do for a couple of days to learn how to read the tape, or is it like an ongoing thing that you always do?
The tape reading exercise, you mean where I put the data down minute by minute?
I believe that's what they were talking about several screens back, yeah.
Well, see, I don't have to do that because I have this software that plots the waves for me and automatically places the volume in hundreds or thousands or millions, depending on the size of the volume in the market, at the turning points. It'll also plot the volume down below as a histogram. I'll show you one of those. We'll see some in a minute, I think.
Okay.
But that you don't have to have an exercise of trying to compute the wave volume with this software.
Okay. Let's see. Lars is asking, how do you determine the number of ticks or points required to change the wave? Do you do it
Good
based
question.
on volatility or ATR or something else?
Yeah, you can do it either way. For example, with the currencies, I use a 3-pip wave and a 500 tick bar for intraday work. And my modus operandi is to set up this chart, the euro, using 500 tick bar data, 3 pip wave, and then if there's nothing developing, I just change the symbol and type in BPM 13 for the June contract of the British pound, and the same setting, 3 pip wave, 500 tick bar. So all I have to do is change the symbol. So I have 6 currencies that I can survey from this one setup. And during the day, something will emerge, usually, if one is patient and alert. But in terms of determining wave size, it is partly a function of volatility. If the S&P was trading at 2,500, I might want to use a 2-point wave. Where it's trading right now, I use a 0.75 wave. For gold, I use a dollar wave. For the 10-year note, I use 1/32nd wave. For corn, I use 1 cent. So one just learns to experiment. You know, if you put a 9-pip wave on this chart, you're not going to have many waves. You're probably just going to have this, and all the way down to the low. So you have to adjust it. And the software allows you to change the settings.
I would assume, though, that you could go, if you're not a scalper or if you're not a day trader, but instead you're longer term or swing trading, you could just increase those, right? And everything would still stay the same. Okay.
You definitely can. You can change it to 10 pip and do daily data.
Okay, just a couple more questions, and then I'll let you get back to it. Andre asking, how do you reason when to use pure volume data and when to switch to a Weiss wave?
I don't use pure volume data. Very little. Because as I said, if you look at, I think I have some examples coming up here. Maybe not. Okay. If you look at volume, you don't get the true force of the buying and the selling. It's sort of lost in time. Let me see the next chart. What was it? Look at this chart. This is the June Canadian dollar. And I want to show you where this is. This chart pertains to this point on this 3-hour bar chart. This was the upthrust and test of a breakdown that occurred on May 16th. This is the May 15th high. All right. So I'm using 5-minute data here. And you see the market is going higher. 2,900, 5,700, 6,600, 5,800. There was a mildly bearish change in behavior here. 3,100 was more than anything that preceded it since this low. But on this down wave, we have 6,600 contracts. And look at the 5-minute volume. You can't tell how much volume actually came in on this down wave. It's not there. But looking at this cumulative volume, until we had a reversal of 3 pips here, I could tell that this was a very bearish change in behavior.
Right.
You see?
Right. And
the market, again, going back to this chart, you see what we did. We dropped from about 98.40 to 96.73.
Okay, one last question. Then
anything else?
Yeah, one last quick question. Charles asking, basically is asking how many bars of delay is there between the swing high low or the wave prints on the screen, and you know, how do you deal with that? How do you overcome that yourself?
All right. Okay. The wave line continues to move higher until there is a reversal. In other words, I don't know what this price is. Let's assume it's 98.36. As soon as there's a 5-minute close at 98.33, the wave turns down. It doesn't, it might just fluctuate. During the formation of that next bar, it might start to turn down, but if it doesn't close at 98.33, if this was 36, then it might still point up. But as soon as you get a 3-pip reversal from this high, this close, it starts to move lower. There's not any real significant lag or lead. And it keeps building the volume until it reverses.
Okay. Thanks, David.
Okay. Now I have a whole bunch of, let me see, what's next? And here's another chart. This is very, very tight, close 200 tick bar on the S&P. I don't remember what day this is, but I'm trying to demonstrate how one can see the changes in behavior for the purpose of scalping intraday. You can see the market takes out this high, and actually it was a high made at 10:30 a.m. earlier in the session. It takes it out with quite a bit of volume, and then it falls back. And on this, on this last arrow, there's no demand. And then on this down wave, look how heavy the volume is on the downside. It's the heaviest volume since this low. And then look at the volumes on the 2 up waves, here and here. There's no demand. And then again, the selling comes in a big way. These are all bearish changes in behavior. Here's the rally back up to test the breakdown. I don't think there's an upthrust there, but the volume is very small, and it's a very nice trade. Look at the demand that came off the low here. First here, and then particularly on this upwave with that much demand. It doesn't take much to be able to recognize when one side or the other is getting the upper hand. Now let me show you something else that I think if Wyckoff had known about Renko, he would have just loved it. And these are Renko waves. In other words, each brick, I assume everybody knows how a Renko chart works. But these are called bricks. And on this chart, each brick is 1/32. There's no time constraint on the construction of a brick. It might take 30 seconds. It might take an hour and a half. You don't know. Right here, for example, the market made this high at 129 and 30 seconds. It takes a move below this low. It has to go all the way 1/32 below that brick to form this brick. And in the interim, it can trade up, it can trade down, it can take a lot of time. But if I have, here's the wave line plotted on top of the Renko bars. Look up here at these up waves, 44,000, 44,000 again, and only 12,000. So it's running out of steam. The other number is how many minutes are on each wave. And then suddenly, look at the supply, 75,000 contracts on this down wave. And look at the little effervescent rally. It's 3,000 and it's 1 minute. And then down we go. And this whole down wave here, right here, the 75,000, is down to 129.21. It's right here on the 5-minute chart. Can you tell how much supply came in on this decline from the 5-minute volume? It's not very visible. It's not readily apparent. But it is here. And these Renko charts are particularly useful because they filter out so much data, and therefore they filter out a great deal of fear and uncertainty. All right, let's see what's next. Well, I'll come to the quiz, but I'm going to be explaining each chart the answer as we go. I didn't think we'd get here quite this fast. But looking at this chart, the question is not if you would go long or short, but is it poised to go higher or lower? And take into account any lines that should be drawn or thought about, any price bars that give you a clue, as well as a wave volume. Anyone know?
We've got several answers going both lower and higher.
All right. Okay, well, the answer is higher.
Okay.
And I'll show you why. Here's what happened. Here's where we were. First of all, just thinking about lines, we had a lot of effort on this 3,900 contract decline and not much reward, and we rallied. We didn't make a new high, and we closed that bar very poorly. So that meant the market was still in jeopardy to go down. On this bar, look at the ease of movement. Look at the poor close. The only thing that tells you it might not continue lower is that the volume is only 900 contracts. But still, the sellers are in control. But there's no follow-through. The market recovers, takes out this high, and has the highest close on the chart, and then on this pullback, very shallow and no supply. And you see what we did. All right, the next question is, and I'm going to continue this chart, what's it going to do next? Is it going to go higher or is it going to go lower?
Okay, we've got a fair amount of answers.
And I see a whole bunch of lowers. And somebody said 43 is a change in behavior. That's right. Lower is right. This is the biggest amount of down volume on the chart. In addition, we broke the upward stride, which is not that terribly. Also, notice that the distance from here to here to here has shortened. But this is the overt clue. And here's what it did. And from this high, which only had 1,100 contracts, you see what we did. All right.
And David, before we move on, I just want to clarify that those last two were for book prizes. So I need Al. You were the winner for the first one, Al. H, I need your BMT username, and I need, let me find the second one. Justin H, you were the winner for the second book, so I need your BMT username, Justin, and then I'll get in touch with both you guys. Okay, thanks.
Okay. All right. Let's see what happened. Let's see the next one. All right. Is it poised to go higher or lower? I see lower and higher and lower and higher, higher. Okay. All right. I guess the answers are in. Quite a few. It is higher. And the reasoning, first of all, from this low to this low to this low to this low is shortening the thrust. Notice the diminished volume on the last down wave, 2,300, 2,200, 600. And then on this downwave, we have 2200, much more than we had here, but we don't make a new low. And then look at the character of this up bar right there. You see how the great ease of upward movement and what's going on against this high. Anybody want to venture an opinion of what that means right there? Anyone who knows anything about it? Someone wrote the word absorption. Very good. That's what it is. Absorption is a process whereby the sellers there are people who were trapped over here, longs, who have an opportunity to close out their longs and get their money back. People who bought here can take profits, and new shorts can come in at this breakdown area. And so the market is trying to overcome that selling. And the clustering of the closes and the higher closes and the pressing nature of those bars says we're most likely going to go higher.
And before we go too much further,
platinum chart.
Ward was the answer for the third book. Ward, I need your BMT username, please. Thanks. Okay, thanks, David.
Anyway, the person who recognized the absorption had a leg up here, but just looking at these wave volumes and the shortening of the thrust and then the larger effort here with no reward, and you see what it produced. And this is all in one morning in platinum. All right. Okay. What's the story here? All right, I see lots of smart answers. The answer is indeed lower. And you can see on the up waves from the left-hand side of the chart, we go from 10,700 to 6,300 to 47 to 28. So it didn't really shorten the thrust, but we're running out of demand, and then we get the steepest break on the chart, and look at the amount of supply. So right there, you know, what did Wyckoff say? When the distance and the volume begins to increase, and here there's another big effort to go up, 3,700, more volume than you had on the last up wave, and it's only a 50% retracement. And here it's a little tricky, because here's 2,500, and it looks like it might be effort versus reward. But then it goes up on 600. And that tells you there's no demand. And then look at these two price bars. Look how they, both of them have sticks where they went up but closed nearer their lows and lower on each bar. So yes, it's going to go lower. This is crude oil. And that's where we were. This is all one day. It did come back up and made a big effort to test this breakdown where we had all of this supply on the breakdown. You can see that this volume corresponds to this downwave right here, this downwave, and we tested it here, and it really broke nicely on that day. This was a great trade. All right. This is a 10-year note chart. These are in thousands of contracts. Okay. Lots of smart answers. Lower, right. And someone said up thrust. You could argue it's an up thrust. All right.
And
what's the big clue?
Sorry, I need Glenn CA's username from the last question, number 4, and then for this question, Jack. Jack, I need your username. Thanks.
Is this Oliver who's getting all these answers? I think I might know Oliver. Anyway, On this chart, it's definitely going to go lower. The first change in behavior was right here where we dropped on 45,000. Then the market ran back up, made a new high, shortening the thrust from the 45 to up here to here. But most importantly, look at the 48,000 coming back down. You might think it's effort. Thanks, Oliver. It does look like effort versus reward, but look at how little volume was on the up wave. Only 6,000. And look at the first bar of the down wave. It tested the high and reversed to close on the low. I'll show you what it did. And down she went on 57,000, and then rallied on 16 and 7,000, and so on. All right. This is a good one. Everybody ought to know this one. I figure if you've answered 7 out of 10 correct, you can quit your day job. All right. A lot of hires here, and that's right. We're going up. And the overt clue, of course, is right here. This is 1,294,000 shares on this up wave, and this is a 1,000 tick bar chart. And look at the pullback, 375,000 and 376,000. And look what we do. It's Apple. It moved up nicely during the day and then gapped higher the next day.
Charles, you're the winner. I need your username. Thanks.
Somebody says he's not quitting his day job yet. All right. I think Apple is probably the quintessential day trading stock. All right, let's go on. All right, what's the story on this? This is another stock. These are in thousands of shares. This is all one day, and it's 5-minute data, not tick bar data. Higher or lower? Someone wrote the name of the stock. I don't know how he knew that. Okay, lower. Down. That's right. What's the clue? The clue is 391,000, and this vertical move up all looks very climactic. Then this big downward reversal on 157,000, up on 95 and shortening the thrust, and then right here, 345 going down, and look at the position of the close on the two little up waves. And here's what it did. Someone said it's Union Pacific, and they're right. No, it's Goldman Sachs. I'm sorry. I thought it was UNP.
Brian F., you're the winner. I need your username, please. Thanks.
So you see what happened, and it was just it just tested every breakdown all the way down. You see how it came back to test the breakdowns. On this test, you have an up thrust of this high, and then it continued lower into the close. Goldman Sachs. Okay. This is a Renko chart. You see the volume per wave, and you see the minutes per wave. The volume on the last two bricks is 2,300. What's it going to do? All you really need to know is to just read the wave volume. However, it's nice to have brick volume, and most software packages will give you brick volume. This is a custom indicator, But still, look at how much selling came out in this one break. If I had put break time under this, I would imagine that that break took quite a bit of time to form. All right, let me show you what happened. That's where we were. And you see what we did.
Andre B, I need your
username. And then we break
username.
on 10,000.
Thanks.
What's telling you down here that it could be ready to have a rally? It's probably the end of the day, but anyway, what's telling you here is the shortening of the thrust from here to here to here, and the diminished volume and the diminished time. This was 25 minutes, 34, 40, and only 18 minutes. All right. Okay, this one I didn't put the price on it. I didn't give any information. This is probably the hardest one. I shouldn't say that. What's going to happen? Okay. The market's going to go down. And if you draw the lines, you see that first you had a low here, and then you had a high here, and you see this rally probably came to the top of the channel, and it's testing this vertical breakdown, and then right here on this downwave we had very heavy downwave volume, and the market finds support here and rallies with good volume, and the clue is a great deal of effort and not much reward, and then it pulls back on a little bit increase in volume, but when it goes up again, there's no demand. So if it turns down from here, you can go short and put a stop there. And here it is, the S&P on June 5th.
Brian H, I need
nice,
your username, please.
And then when it turned down, you see how much supply came in. And then, of course, we get another test of the vertical high volume breakdown with a pretty good amount of effort but no reward. Poor clustering of closes without any upward progress. All right. What's this one going to do? This is a daily bar chart, and the volumes are in millions of shares. This is a stock. What's it going to do? Okay, we're getting all kinds of answers. Well, the answer is that we're going to go higher. And this is what we did. Here's where we were, right here. We rallied and we tested. So we have a spring. But look at how much volume came in. Let me go back to the chart before. On this downwave, about $1.79, there's 20 million shares. What is going on there? That is definitely effort versus reward. Wyckoff referred to this as bag holding. Someone is holding open a bag and letting the whole world sell into it, and they're taking everything that's being offered without bidding it higher. This is accumulation.
Sorry to interrupt.
Someone showed me this chart.
I need the last two usernames. So Brian H, I still need your username, and John L, I need your username, and then that'll be the last. That's all 10 books. Thanks.
All right. Someone showed me this chart at this point. And he said, what do you think this stock is going to do? He was a mentoring client. And I said, I think it's going to explode. And he said, well, why? And I told him about the bag holding here and the spring, and that this market is preparing to go up. And I said, why are you interested in this stock? He said, well, I know who's manipulating it. And I said, well, that's interesting. Who is it? He said, well, I believe it's Carl Icahn. I don't know if that's true or not. But you see what it did. And it really revealed itself on that 20 million downwave right here with no reward for all that effort. And then coming back up above the horizontal line and pulling back to test on only 6 million. No supply. Okay. Well, those are all the quizzes. That's all I had. I was went through a little faster than I expected. Any other questions?
Yeah, let's just open it up for general Q&A. So if anybody has questions, now's the time, and we'll get a few of those answered here. So thanks, David, for your time, by the way, and putting the presentation together in the charts. I appreciate it.
My pleasure.
Okay, let's see what we have. Julie is asking, how do you get the contract numbers? I think maybe she's asking the method that you're using to accumulate the wave volume. It's just simple addition, right, from wave to wave?
Yeah.
Okay.
Yeah. Let me just put up a chart. This is just on this downwave right here. This is a 5-minute chart of Google, and so it's adding the volume for each 5-minute period. You see? I can't read these numbers. If you'd like, can I change to TradeStation?
Yes, sure.
Mike?
Yeah, go ahead.
I can just show a chart today. Here's the S&P today. This is a 5,000 tick bar chart. And the market moved up here on 94,000 contracts. I couldn't tell it was over. And then it had a small setback and a low volume rally, only 17,000, which was the lowest in quite a while. And then here's a change in behavior, 138,000, right here. How many periods is that? 1, 2, 3, 4, 5, 6, 7, 8 time periods. 8 5,000 tick bars in that downwave. And this is the volume. The volume after the first tick bar was 17,000. The next bar was 21, so now the total is 38. And the next one is 55, so we know it was 17,000. And it's just cumulative, building as it goes. That's how I get these numbers. The volume is plotted here, and it will also plot right here underneath each wave or above each wave. And you can see right here, for example, I noted at the time, because I was trading the market, that right at this bar, the third bar in this upwave, the volume was bigger than on any upwave since this high. So I knew that we were getting ready. The force of the buying was building up like a tea kettle on the stove. It was boiling to take off, and it did. It went all the way back up here on 127,000 contracts. What other questions?
Okay, Andre asking, can you describe any scenarios or market behavior that make it difficult to read Wyckoff? He says, if there's such scenarios, do you use anything else to complement Wyckoff?
I don't use anything else. I mean, you could use point and figure work. Wyckoff spent a great deal of time working with point and figure charts. Much of his original course is about point and figures. They give you more information. You could make a point and figure count off of areas on a chart to project how high or how low it might go. You could even use the wave line as a proxy for a point and figure count. I mean, look, here's a high here. 1 wave, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. There's 11 waves up here. Imagine that those are 11 columns on a point and figure chart. Multiply 11 times 0.75 and you get 8 1/4. Well, we subtract 8 1/4 from 39 1/4 and you get a move to 31. Well, it went much lower than that. So that didn't work out too well. But a real point and figure chart might be something that could add more to the Wyckoff story. But I don't feel like I need any other information. I mean, take a look at the 5,000 tick bar volume. I'll put the volume underneath the chart. Does that volume tell you anything? Can you see how much supply came in on this down wave right here from this volume? You can't. That's the fallacy of chopping up volume into equal bundles of time or ticks. Next question.
David, I've got a quick question of my own. In the grand scheme of things and all things trading, where would you prioritize things like methodology, psychology, and risk control? What order would you put them in?
Well, I think for me, and for most people I've encountered, and I do a lot of mentoring, so I think psychology is first and foremost. I know most people talk about risk management, and obviously it's very important, but what one does with one's mind when you're trading is it can be so destructive. One of the things that how do I get back to the charts that I had? Did I lose them? No, here they are. One of the things that I like about Renko, let me just find it. Well, I don't know where it is now. Must be around here somewhere. One of the things, I can't find it, but anyway, one of the things I like about Renko is that I call it peace of mind. You don't have to think so much. Hamlet said, nothing is good or bad, but thinking makes it so. How many times have you put a trade on, and because you start thinking too much, it's like rubbing a sore on your arm, and that sore becomes a bloody mess. It's what happens to your thoughts. So I personally opt in favor of the psychology of trading being more important than risk management and methodology.
Okay, thank you. Let's see, Brad is asking, basically he's asking to give us a little bit more detail on stop and target placement. So once you've identified a potential trade, what do you use personally for setting your stops and targets?
That's a good question. If one had gone short, as it turned down here, I would just keep lowering my buy stop, and this is pretty standard, above the previous pivot. So as soon as it goes down to here, lower the stop to here. As soon as it rallies to here and turns down, put it there or put it here, and so on, until you're stopped out. That's what I like to do with stops. In terms of targets, what I normally do is I draw channels, and I watch to see if we get down to the bottom of the channels, or overbought, oversold or overbought, and that alerts me to the idea that I should be considering lightening up and taking profits. I mean, look at this down channel drawn from this high to here with a parallel here. I can see that the wave volume, the down wave volumes are diminishing. I can see that we're oversold in the channel. Why not get out? Does that help?
Yeah, Andre asking if you can explain in more detail reverse trend lines and when they're useful.
Very good question. All right, in a downtrend, a normal channel or trend line is drawn across two highs, as you see that I've done here. But you can also draw a downtrend line across lows, like so. And that's particularly useful in a very steep move. And what I usually do, what I learned from the Wyckoff course, was to make the reverse trend lines dashed, like that. And you could even make it into a channel. Well, you draw a parallel here and make a reverse trend channel. In an up move, a reverse channel, a reverse trend line is drawn across highs. Let me just see if I can find one. Okay, this one doesn't work. Well, let's see. You draw from this high across to this high, and you know, it certainly shows that you're overbought in that, but that's not the best line I could have drawn there. There's no channel that works on this chart. It's too steep. But reverse trend line going in an up wave is drawn across highs. In a down wave, it's drawn across lows, like right here. Does that help? And it's a great tool. It's very predictive.
Yeah, I believe that does. Bob is asking if you pay any attention to cumulative delta, which I'm not sure if you're familiar with it or not. It's kind of a hot topic on BMT. It's basically measuring volume that occurs at the bid versus the ask.
No, I don't. I don't do it.
Greg asking.
I used to use market delta
right.
years ago, and I think volume at the bid and the ask could be very useful. I don't denigrate it in any way.
Greg is asking about pivots at the wave low with heavy climatic volume. Do you count the volume on the climatic bar as a down wave volume or up wave volume?
Well, it depends on the close of the bar. I mean, if the wave goes down to the lowest close, so if that's where the heaviest volume is, then it prints it right here. I don't know if I understand the question any beyond that.
Helder is asking about pulling the trigger, and basically I think he's saying that because of the nature of the way the waves work, or the swing high-lows or the zigzags or whatever term you want to put on them, they can still change up to a certain point. So I think he's maybe talking about the delay from the print versus taking the trade, pulling the trigger, and then if it happens to change on you.
Well, I want to see, I don't want to just buy what looks like a selling climax, for example. I want to see some sign of demand. I rarely buy selling climaxes. I want to see a light volume secondary test. I want to see the market lift off with some demand, or then pull back with very low volume or very heavy effort. I mean, look here. This 883,000 shares was the heaviest of this down wave. It stopped it, and then we rallied on second heaviest up wave volume since earlier in the morning. That looked constructive, and then right here it comes back with more downwave volume, I mean fairly heavy downwave volume, and then reading these bars, I would be a buyer, or waiting for this to happen and waiting to be a buyer.
Brian,
I don't know if I mean.
Brian is asking if you could go back to TradeStation on the ES chart. He's asking if you could identify where you would go long with the increase in up volume well into the first thrust.
Where I would go long?
Right.
I went long right here. I went long in here, seeing how much the upwave volume was building. It was heavier up to this point, you see. At that point, we had 51,000 on the upwave. That was more upwave volume at that point than on this upwave, this upwave, this upwave, or this upwave, or this one. So I could tell that we were absorbing against this high and we were going to break through. The probabilities favored it, and I didn't have to risk very much to find out.
Oliver is asking your opinion on using...
Let's see.
Sorry.
What'd you say?
Sorry about that. Oliver asking your opinion on using point and figure charts versus Renko charts.
I think Renko has more information than point and figure charts. But if you use Ninja Trader and not TradeStation, you have a nice setup with the point and figure charts showing volume underneath it. So you have volume on the columns, the point and figure up and down waves. And that's a nice feature. And if you have the wave software that I sell that works on Ninja, it will plot the up volumes, the numbers on the point and figure. I can't do any of that in TradeStation. So that is a nice feature, but I still am a little more partial to Renko because I can tell how much time and how much volume takes place at each brick. And that's very, very interesting information.
Joe is asking if you could confirm that you are all in, all out versus scaling in or scaling out.
I'm mostly all in or all out.
Okay.
And particularly in terms of day trading. If I'm swing trading for 1 to, say, 3 days, I may lighten up some. But most of the time I am all in, all out.
Okay. A question of my own follow-up for that. Do you consider yourself primarily a scalper, a day trader, or a swing trader?
Mostly a day trader.
Okay. Franz is asking if you use any automatic trading systems, or is it all discretionary?
It's all interpretive.
Okay.
No discretion.
Okay, so you would say that it's mechanical. So you have
what?
You would call it maybe mechanical, so not so much discretion. You're just waiting for a certain set of
no,
rules.
it's my discretion. It's my discretion.
Okay.
I'm trying to interpret what's going on.
Okay.
And making a bet when I think I understand it.
Gotcha. Let's see. We've got most questions answered. Let me just look. There's a few here left. Let's see here. Phil is asking, some of these waves have high cumulative volume, but they also developed over a period of time that's much larger than the other waves. So the high total volume should be expected given the high amount of time associated with the wave. So he's therefore asking, have you looked at normalizing the volume scores in some way by having each wave like divided by the number of bars, for example?
No, I've never done it. Well, I used to do it when I made charts by hand. I did things like that as an experiment. But what I have now, I'll show you. I have an indicator that I've created that shows the amount of time per wave. And I find it very useful to see, for example, on this down wave with 46,000, we had, how much time is that? 13 minutes. That was more time than on this down wave. So that's showing that it's not moving down very willingly. No sustain to it. And I think one can trade, you could almost trade this chart using time per wave as easily as you could volume per wave. You see how much time you had on this down wave, and that could be equated to volume. It's amazing how the correlation between time and volume.
Would you consider yourself to be a trend trader or a counter trend trader?
I think I'm more of a counter trend trader because I'm looking, like right here, I'm looking for a bearish change in behavior and then a pullback with no demand or low demand.
Let's
But
see.
I mean, sometimes I do jump aboard trends.
Andre is asking if you have any other good book recommendations for beginners in Wyckoff or just general books that would complement your own books.
That's a good question. In terms of psychology, I like Mark Douglas's, everybody knows it, Trading in the Zone, where he says that one has to accept the fact that we're dealing in a probabilistic environment, that anything can happen and no one knows what's going to happen. If you're comfortable with that, then you can be a trader, my son. There's a lot in his books that I like and I think are useful to people who are starting out.
Helder is asking about VSA or volume spread analysis, and that's long been somehow associated with Wyckoff. What do you think about the importance of that?
Well, Tom Williams, who developed this, definitely knows the ins and outs of Wyckoff method. And he described it very well in his book, The Undeclared Secrets of the Market. I think that's what it's called. And it's a good book. In terms of VSA, I think VSA offers an excellent way to learn how to read price volume behavior, because if I understand it correctly, what I've seen in demonstrations is that it provides you with clues as to the interpretation of behavior as a market unfolds. And those clues are couched in terms of the Wyckoff method. And so I think that's very useful.
All right, 3 questions left. Let's see. Actually, several people have asked about trading currencies on the spot Forex market, and because that's an unregulated, decentralized, do you think that it still works for volume if they're just using volume from one of their banks or brokers, or would you recommend they use volume on the futures market, or just not to trade spot Forex at all, or what do you think?
Well, I've never traded Forex. I must say I'm intrigued by it. And one nice advantage of trading Forex is that you can trade a very small size to learn more about it. You can, I think the contract on the euro currency is, what, 100,000 euros? You probably can trade a contract in Forex of 10,000 euros. And so every pip is not going to be $12.50, but it's going to be something much, much smaller. Trading with volume on Forex is a little trickier. Maybe can I make a chart real quick? Is that all right?
Sure, go ahead.
I'll just put one up. Let's do the sterling yen. very volatile one, but has lots of good signals. First thing you have to do in TradeStation is to use tick volume instead of trade volume. So I just tell it I want tick volume. And then I just put the wave line on top of it. And you'll see how I format it. I'm going to use the same 3 pips. And I'm putting the volume in hundreds of ticks. And why didn't it work? Well, it's late in the afternoon and TradeStation does funny things. And it's locked up. So I can't show you. But
okay.
It works very well. Wait a minute. Let's see. TradeStation has experienced a problem and needs to shut down. Can you believe it?
That always happens. Okay, so I think there's 2 questions that we can do. One is, I'm trying to find who asked it, but I can't find who it was. I'm sorry, but I remember the question. What do you consider your methodology as far as like how do you start the day? Is there like a top-down analysis from a bigger chart to a medium chart to a smaller chart? How does that process work for you?
Well, since I do a lot of work with the currencies, I usually I start by looking at the daily, the overnight action on the daily, and then zero down to the 3-hour or the hourly chart and start drawing lines on it, and then just set up the 500 tick bar chart and start monitoring it. I usually monitor the S&P and the currencies, and sometimes I move over to some other market, but most of my efforts are around those.
Okay.
6 currency futures and the S&P mini.
Okay. And as I asked this last question, if you could throw up the last slide with your contact info also.
All right, I'm sorry.
Paulo is asking, and I think this is a good question for everybody, most everybody. Any general advice, just anything you want to say to those traders out there that are maybe a little bit newer, maybe still struggling, not quite turned the corner, turned the page yet? What would your general advice be to those guys?
It's a great question, and you're doing a good service by asking that, Mike. I think the number one problem that people have is changing horses. In other words, you start off and you're doing this and then you're doing that. It's understandable when you first start that you have to experiment a little bit. But try to find something that you can work with for a while. Give it a chance. Spend a lot of time with it. Whatever the method is, if it's Gann, if it's Elliott Wave, if it's Wyckoff, if it's market profile, whatever the method might be, and really become familiar with it. And don't just toss it away real quickly and go to the next whiskey bar. Stick with it. Try to gain that insight that comes, that intuitive feel. That's what Wyckoff said. He said the purpose of his little book, Studies in Tape Reading, if you can imagine, the purpose was to help develop an intuitive judgment that would come out of 6-7 hours a day studying the ticker tape. So I just think that's most important, is to stick with something. And also not to spend as much time, this is with mathematical indicators. I know that they are very, very popular. As one person who's in the software business in the market, someone who was selling a platform, the owner of it, told me the indicators are just window dressing. We're just trying to cover all the bases to get people to use whatever it was, CQG or whatever it was. It wasn't CQG. And I think it's a terrible trap to put all of your effort into working with mathematical indicators. Try to listen to what the market says about itself through whichever method you use.
Very good. Thank you very much, David. I really appreciate all of your time for the presentation and to answer everybody's questions today. And for anybody that did not get their questions answered, or if they just want to talk to David, right there is his email address and phone number. You can also find him on his website, Weis.com. And congratulations to the 10 book winners. I will contact you shortly. Also, even if you did not win the book, you should go to Amazon and check out David's book, Trades About to Happen. And if you want to see what else products and services David has, you can check out his website for that. So guys,
well, I sure enjoyed it. I really did.
Same here, David. I'd like to have you back sometime, maybe in a few months. And I will send you the recording here later tonight or early tomorrow, and I'll post it on the forum as well. So thanks, guys, and I hope everybody will stay tuned for the other events that we have for the rest of the month. We still have something like 8 more webinars to go. So, okay, guys.
Take care.
Thanks.